Hey everyone, hello and welcome to the November Open Topic live stream. Some exciting things have happened in the last month since I was last doing a live stream on an open topic, open to all of your questions and answers. And I just heard, in fact, that there was a massive collapse in the price of various cryptocurrencies, and now they are trading at the price they were 3 days ago. A catastrophic calamity, unprecedented in the history of cryptocurrencies. Oh no, what are we going to do? So it's been a bit of a roller coaster. And for those of you who are recently joined and interested in this space for the first time, because of course you are interested primarily in the technology, welcome to your first roller coaster. And for those of us who have been around for a few times, we have ridden this roller coaster before. This is all pretty much old hat. We've done it before. It goes up, it goes down, and usually it's best to just not pay too much attention to that. But for those of you who want to play around with the concept of a roller coaster, please note that we have a custom emoji. This is a kind of loosely based on a classic design that a wonderful artist has made of the Bitcoin roller coaster, and you can try that out in the YouTube chat now. So it's been an eventful month. By the way, I have some very important news to share. Something remarkable has happened over the last month. I have a new mug. Yeah, I have a new mug. And my new mug has the slogan, "Rules Without Rulers," which is the title of one of my not so old, fairly recent talks that I gave, Rules Without Rulers. It's actually one of my more popular talks, so if you haven't watched that talk, check it out on my channel. You don't need to have the mug to fully enjoy the talk, but it does help. So we have lots of great questions today. If you didn't catch it, the Slido code was on screen for several minutes just before we started, but the Slido code for this week is #grateful. #grateful. And that's because it's Thanksgiving here in the United States, but you know, we're grateful more than just one day a year. Let's get started with our first question. Our first question comes from Anonymous. What are Merkle trees and how are they used in Bitcoin? Very good question. So a Merkle tree is an invention by cryptographer, mathematician Ralph Merkle. So they're named after a person. Merkle is Ralph Merkle's last name. And a Merkle tree is a special type of data structure that is used in computer science. And it is a tree, meaning that it is a data structure where numbers are connected together in a shape that looks like an upside down tree. In computer science, our trees are like this. So the root is at the top, and then it goes all the way down to the leaves at the bottom with branches at every level. Trees are common data structures used in computer science. And in the case of Merkle trees, what's special about Merkle trees is that Merkle trees are made by hashing. So at each level of a Merkle tree, each level of a Merkle tree is a hash of the concatenated data from the level below. So let's look at one section of a Merkle tree. The simplest form of a Merkle tree you can have is a one-level Merkle tree. Actually, that's not entirely true. You can have, well, I guess it is. Let's start with a two-level Merkle tree. So this is a Merkle tree with height 2. You've got, at the bottom, you've got 2 values. Right here, very good, 2 values. And these are then hashed together. So the two values are concatenated and their hash is calculated and the hash goes here. Now, as you can imagine, you could now go further down and do that with 4 values and then hash those values up to make 2 nodes and then hash those together to make another node. So now you have one node that represents 4 values. Now, if you keep doing that, what you can do is you can build trees that have lots of levels, but the interesting thing about these trees, because they always have 2 branches for each node, is that they operate as a power of 2. So a tree with 10 levels will have 1024 values at the bottom, all of which are summarized as a single hash at the top. Now, trees like this have some very useful properties, but the main idea here is that you can take a very large number of values, and because you have a log2 relationship between the number of values and the levels in the tree, you can actually summarize them very efficiently. So if at every level you hash 2 values and then you hash those up again and then you hash those up until you get to a single hash at the top of the tree, that hash at the top of the tree will be 256 bits if you're using the SHA-256 algorithm, even though you may have thousands, hundreds of thousands, or even millions of hashes at the bottom of the tree. In the leaf nodes, you can summarize all of those with a single 256-bit hash at the top. So Merkle trees are used in Bitcoin to summarize information in a hash. But they have another very interesting property, which is that you can prove very easily that a specific value is part of the tree without producing all of the other values that are part of the tree. So you can show this property with a Merkle tree. You can say, I can prove to you that this value is somewhere in the bottom of this tree by giving you 1 hash for each level of the tree, which means that if you have a tree with, let's say, 4,000 values, you can summarize it with just 11 hashes. You can prove any one of those 4,000 values with just 11 hashes. 8,000 values with 12, 16,000 values with 13, etc., etc., etc. So each level you can summarize twice as many data points with a single hash. So the way we use this in Bitcoin is to summarize all of the transactions in a block. So there is a Merkle tree, which is constructed by putting all of the transactions at the bottom of the Merkle tree and then pairwise hashing them up until all of the branches converge into a root hash. That is called the Merkle root, and that characterizes the entire tree, and you can now prove that any transaction ID, is part of that Merkle root and has been summarized in that Merkle root with a very short proof. This allows you to record all of the transactions that are part of the block in a single 256-bit value hash, which goes in the block header and on which you solve the proof of work. That means we don't need, even if we put a lot of transactions in a block, maybe we have thousands, maybe eventually we end up with tens of thousands or hundreds of thousands of transactions in a block, the actual summary is still the size of a single hash, and we can prove that block and prove that the transactions belong to that block without having to carry all of that information. So Merkle trees are data structures that use pairwise hashing to summarize very large amounts of data in a structure that grows only by the second logarithm, the logarithm of the number 2 of the number of values, and allows us to prove with a log2n proof the existence of a specific value in the tree, and we use that to summarize transactions in a block. Now, there's another place Merkle trees are used since the introduction of segregated witness, which is to summarize all of the signatures in a block, the segregated signatures, the segregated witnesses, and that's a separate Merkle tree. So there's the transaction Merkle tree with the transaction Merkle root, and then there's the witness Merkle tree with the witness Merkle root that goes in the Coinbase transaction, which is used to prove the existence of all of the signatures that are existing for all of the transactions in a block. So that's what Merkle trees do. Very, very useful. Thomas has a follow-up question. The follow-up question is, so are Merkle trees not planted by Frau Merkel in Germany? No, but you know the old saying that says money doesn't grow on trees? Well, in Bitcoin, money does grow on trees. It grows on Merkle trees. A somewhat technical question to get us started. Whet your appetite. If you're a bit confused, don't worry. It's not that important. One of the interesting things about this technology is that you don't need to understand all of the details in order to use it. Although you can learn a lot of new things, interesting things, at least to me, interesting. And the more you learn, the more adept you can become at using this technology. So we started off a bit technical, but we'll continue with some technical questions, and then we'll mix some beginner questions and non-technical questions in there so that everybody feels comfortable participating in this live stream. All right, let's see what we have next. Next question comes from Tigerix. Tigerix asks about Lightning Pool. Can you explain what it is, how it works, and give your vision on how it might shape Bitcoin's future? Always love your projections. Thanks. Thank you, Tigerix. So Lightning Pool is a product, I guess, that was recently announced and launched by Lightning Labs. And Lightning Labs is one of the companies that works on the Lightning Network and makes one of the popular clients called LND, the Lightning Network Daemon, which is the Lightning client that's written in the Go programming language. And this company has recently launched Lightning Pool. And what Lightning Pool is a distributed marketplace for buying and selling liquidity in the form of Lightning channels. Now, what does all of that mean? What that means is that when you're operating on the Lightning Network, one of the challenges you'll find as an operator of a new Lightning node is that while you can open channels to other nodes in order to be able to send payments on the Lightning Network, you can't actually receive payments until someone opens a channel to you. And this is called incoming or inbound liquidity. Until you have inbound liquidity, meaning that someone opens a channel to your node, you can't actually receive money on the Lightning Network. Now, there are a number of ways to solve this. You can ask a friend to open a channel to you. Or you can open a channel to, say, a merchant, and once you've sent a payment to them, now there's some liquidity on the other end of the channel, and now you can get paid at least that amount. You can get paid at most that amount back in an incoming payment from someone else routed through that channel. But if you're doing things where you want to receive lots of payments, like running a shop, it gets a bit complicated, and actually having incoming liquidity is a bit of a problem. You could have every customer open a channel to you, but the purpose of the Lightning Network is to not have to have a direct channel with everyone who wants to pay you. So what people are doing instead is renting liquidity. And there have been a number of informal marketplaces that have been set up by various companies where you can go and say, I want a 500,000 Satoshi inbound channel to me so that I can receive payments up to 500,000 Satoshis inbound into my node. And a company will quote you a percentage fee to run that for a period of time. So for example, they'll say, I'll give you that capacity for a month for 0.01% of the amount. And you pay that fee with a Lightning payment, of course, and they open a channel to you. Lightning Pool is taking that idea and turning it into a protocol. So now you have a marketplace where people can place bids and make offers for Lightning capacity, And so I can advertise that I'm willing to sell Lightning capacity of, say, up to 500,000 Satoshis, and that my price is 1 basis point or 0.001% or something like that. And someone else can go and look at all of the available offers for Lightning capacity and make a bid to buy some Lightning capacity. And then the Lightning pool system will match those two orders up like a marketplace and will allow us to essentially buy and sell this capacity. So I can buy inbound capacity, someone else can sell inbound capacity to me, and we can meet based on the price we charge for the period of time that we want to have that capacity. So that's what it is. It can create a number of interesting possibilities. First of all, it solves a fundamental, basic bootstrapping problem in the Lightning Network, which is that all new users need inbound capacity. Really, there's only a couple of ways to solve that. And one of the equally good ways to solve that is if exchanges allows you to withdraw from an exchange directly to a Lightning channel, because then what you could do is you could buy Bitcoin in an exchange, withdraw it by creating a channel to your node, and that would be inbound capacity, and then you would have inbound capacity and the ability to receive payments, and presumably the exchange would have quite an incentive to give you additional inbound capacity for future withdrawals. But in the absence of that, a marketplace is what we have. There is another little wrinkle to this, and that is that this concept of inbound liquidity is actually using a form of sidechains in order to implement this decentralized marketplace of liquidity. And that sidechain can be used to buy and sell other kinds of smart contracts. But that's for future development. For now, just assume that it's a straightforward decentralized marketplace for Lightning channel inbound liquidity. All right, let's see what's happening on the chat. Let's see how people are doing with this conversation. If everybody's enjoying themselves, I hope they are. We have 202 people so far. All right, and some people trying to ask some questions in the chat, which is not where you ask questions, and then wondering why I'm not going to answer them. So let me get started with my next question. Anonymous asks, I'd love to run a Bitcoin or Lightning node at home, but I have very limited bandwidth. What are solutions to that? Could I run it only at night, for example? Anonymous, not really, because what would end up happening is if you ran it only at night your bandwidth would get absolutely hammered because your node would have to catch up. This is assuming you're talking about a Bitcoin node. For Lightning nodes, you need to remain online 24/7. So you can't really do that when you keep disconnecting. But for a plain Bitcoin node, you can, of course, connect and disconnect and connect and disconnect. The problem is that every time you do that, your node will be playing catch up, and it will need to download all the latest blocks that have arrived. You can tweak the settings of a Bitcoin node to limit the amount of bandwidth that it uses, but this is primarily to limit others from trying to download blocks for initial block download or syncing from your node. So you will provide the latest blocks and latest transactions just like any nodes. You will send and receive those to your peers, but you will not just allow other nodes to connect to you and ask for random blocks all over the place and start downloading blocks. You can do that with some settings on your Bitcoin node, but you're still going to need some bandwidth in order to operate a Bitcoin node. And that bandwidth It's basically going to be about 4 or 5 megabytes per block. So every 10 minutes, you're going to be using about 4 or 5 megabytes of bandwidth. And that's because you receive a block once, but you've also already received most of the transactions in a block, as well as other transactions that didn't make it into a block. And then when you receive a block, you also send it out to many of your peers. And so each time a block comes out, you're going to have to send and receive that data multiple times. That's what your node is doing in the background. Now, it depends on when you say you have limited bandwidth. That really depends, because limited is a relative word. It depends what you mean by limited. If by limited you mean that you don't have the ability to do 60 to 100 megabytes of data an hour, then yes, that's truly limited bandwidth, and in that case you can't really run a Bitcoin node directly connected to the internet. However, there is another interesting way to run a Bitcoin node, and that is especially designed for rural, remote, and low bandwidth situations, and that is to run it off a satellite dish. So a company called Blockstream has leased capacity on commercial satellites. And you'll hear people talking about Bitcoin satellites, and you might think that means that someone launched the satellite just to do Bitcoin, but that's not in fact the case. Instead, you can lease bandwidth on a commercial satellite at specific frequencies and connect that with a ground station to transmit information, just like satellite TV companies do, for example. Now, in this case, Blockstream has leased channels on some satellites that serve different parts of the world. And with those satellites, they transmit blocks and transactions through the satellites to receiving stations that are based on a very, very simple satellite antenna that looks a bit like a satellite TV antenna. In fact, it's the same thing. And you can even repurpose an old satellite TV antenna of a specific size with the correct transceiver for the correct frequencies and a special software-defined radio that plugs into a USB port on a computer, where you can then run a Bitcoin node that receives blocks and transactions from the satellite. Now, you can also have that Bitcoin node connected to the internet as a backup, but receive most of its information from the satellite, thereby very much reducing your bandwidth. And this is a fairly effective mechanism. You could also, if you want, run a Lightning network on the internet, but run the Bitcoin node that backs it via the satellite feed, therefore, again, saving a lot of bandwidth. If you're doing this for other reasons, you might simply do it for fun, because, setting up a satellite dish, a software-defined radio, a Bitcoin node on a Linux computer, and all of the combination of hardware, radio hardware, and software is quite an interesting geek project, maybe a good weekend project. The total cost of this is somewhere around $200 to $300 for the satellite dish, transceiver, and software-defined radio. Together with the computer you're running the Bitcoin node, maybe you're looking at $500 or $600. And it will give you a great degree of satisfaction at the end of this to know that you're connected to the Bitcoin network via satellite, as well as some cool bragging rights if your friends are as nerdy as I am and will see that as something to brag about. So think about that. That might be a good fun project. Yes to Crypto asks, popular browser extension Metamask allows easy crypto transactions on the web for Ethereum and Ethereum tokens. Why isn't there a Metamask for Bitcoin? Well, in fact, there have been several similar projects over the years that provide similar functionality as Metamask. These are called browser wallets. And there are a number of browser wallets that have existed for Bitcoin. I can't remember their names right now because I haven't used them in a very, very long time. In the case of Bitcoin, due to the security culture of Bitcoin, a browser wallet doesn't really make much sense. Because of the security culture of Bitcoin, connecting to a service provider instead of your own node in order to operate a wallet, as well as running a wallet in the low security environment of JavaScript inside a web browser, are both kind of not natural fits for Bitcoin's model and Bitcoin's security culture. They're much more relevant in an environment where you're looking at building decentralized applications, or dApps as they're known, where the dominant language is JavaScript, where a lot of the things are interactive and in the browser, whereas in Bitcoin, where the primary function or application is that of money, and even more specifically store value, it doesn't make much sense to use the kind of degraded security model of a browser wallet. There is one exception of one browser wallet that I know that is still fairly popular, and that is a Lightning browser wallet. And because Lightning is much more suited for small transactions, live applications, microtransactions, and interactive applications, and of course it needs to be online, then it has a much better fit with a browser wallet. The browser wallet for Lightning is called Joule, and if I'm not mistaken, it's pronounced Joule, like the International Metric System measure of energy. So Joule is one browser wallet that I know, and I haven't seen any others for a long time now. Last time I remember a Bitcoin browser wallet was back in 2015 or so. And given all of the security problems, I think the industry, especially in the Bitcoin space, has moved much more towards offline, cold storage, and more secure solutions such as hardware wallets, and as much as possible away from web wallets, desktop wallets, and worst of all, browser wallets. If you look online, you're going to see that a lot of people make very, very bad mistakes with things like Metamask. Now, don't get me wrong, Metamask is a very useful platform. I've certainly used it. It's in my Ethereum book. It's absolutely relevant for testing, for application development, for using small amounts, for testing various applications, for various DeFi applications, and it provides a very nice common platform, which is more in line with the Web 3.0 vision of Ethereum. But I would never put more than $50, maybe $100 at most inside a browser wallet like Metamask. And you read these horror stories online where people are putting thousands and thousands of dollars onto a browser wallet like Metamask and then getting badly, badly burned when they make a mistake. The most recent one I read about a couple of weeks ago was where someone had $18,000 on a Metamask browser wallet, and they managed to set the transaction fee incorrectly. And in order to do a $10 transaction, they ended up paying an $18,000 fee, basically draining the entire Metamask wallet balance, and then couldn't get their money back because that transaction went through. In fact, the miners prioritized it. All right, so this is a good time to take a brief little break, and I'm going to use this opportunity to say thank you to all of my patrons. And in order to do that, I'm going to bring up a little graphic to thank by name all of the patrons who make it possible for me to do this work, to provide neutral, unbiased educational content in as many languages as possible, and to build the quality, the production quality, the delivery, the content, the reach of this educational mission by building out a whole team of people who work behind the scenes to make this possible. And of course, that's not easy to do, and it takes a long-term steady commitment of income, which of course in a volatile environment like Bitcoin and other cryptocurrencies that we operate in is very difficult to do. So let me say thank you. My patrons are the cats meow, and I'm thinking of the more than 750 community builders on Patreon. This is just a small sample. We ask the patrons if they would like to have their name highlighted on the show. And this is an opt-in process, of course, because we would never break the privacy of those who are supporting this work. And many remain anonymous and want to remain anonymous. But many patrons also do want to see their name up and receive that special thank you from me. And I absolutely, and with a lot of gratitude, want to thank all of the people who contribute month in, month out, and make it possible for us to do this work. So you'll actually recognize many of these names are here in the chat today, as with every live stream. The regular participants in all of the activities that we do, asking great questions, interacting in the chat, and helping make this work the best that I can make it. So thank you. Let's see what else we have here in terms of Q&A. Quick sip of coffee before we continue. All right. Our next question comes from Donald Trump. What is your opinion about the rumored burdensome crypto wallet rules that I, Donald Trump, may rush out soon? Thanks. So you've probably heard about this. There is a rumor going out that Steve Mnuchin, Secretary of Treasury, is about to release some regulations that apply to so-called self-hosted wallets, also known as wallets. Self-hosted wallets are the wallets you should be using. Self-hosted wallets are what we call non-custodial wallets, which are wallets where you control the keys. And in the financial industry, both here in the US, but also we see in Europe and many other countries around the world, financial regulators are getting very nervous about this general idea of what should we call it? Sovereignty, independence, civil rights, self-expression, freedom of association, assembly, and speech. Burdensome civil liberties and freedom. So what they're trying to do is regulate the use of self-hosted wallets. Most recently, last week, the CEO of Coinbase, Brian Armstrong, did a whole tweet thread about how concerned he was and how much he objected to the possibility of there being regulations of self-hosted wallets and how burdensome these would be on Coinbase. But here's the interesting thing, because all of these regulations, they're not about banning the use of self-hosted wallets. They're not even about regulating how you use your self-hosted wallets, because of course you can't regulate the use of self-hosted wallets. It's not possible to tell people what software they can or cannot run on their own computers. Although, well, okay, strictly speaking, it is possible to tell people. Not many will listen. It is not possible to enforce what software people run on their own computers, and therefore, as long as we have free and open computing devices, which I believe we will continue to have indefinitely, that cat's out of the bag, we will be able to run whatever software we want. People can make it difficult for you to get software. They can make it illegal for you to use certain types of software. But they can only really do that in countries that have a tendency towards dictatorship and draconian attitudes towards civil liberties. So what are we talking about when we talk about regulations on crypto wallets in the US? What they're talking about is requiring you to prove when you withdraw from an exchange that the address you're withdrawing to belongs to you. And this is one of those classic regulations that have been thought up by people who really don't understand how this technology works. Because, of course, there isn't really a way to do that, and it's kind of pointless. But the general idea is this. In order to prevent people from withdrawing to addresses controlled by dangerous criminals, terrorists, and other things like that, especially since exchanges have various blacklists of addresses, etc., what they're trying to do is impose regulations whereby you have to prove to your exchange, or perhaps simply testify to your exchange, that the address that you're withdrawing to belongs to you. Now, Brian Armstrong and people who run exchanges are notably worried about this. And the reason they're worried about this is not because they're great proponents of freedom, of course, but because this would really cause a problem for exchanges. You see, right now, if people have money in an exchange wallet, they use that to make payments to all kinds of different places. They use it to buy stuff on the web. They use it to transfer money to their friends. They use it to send it to gambling sites and various other places. And they do a lot of that under the guise of a withdrawal, because as long as the exchange can kind of look at these addresses and say, well, it's not on our blacklist, so we're okay, and there's no further requirement, they can turn a blind eye to the fact that the address you're withdrawing to is basically an address on a competing exchange, on a gambling site, on a porn site, the address of your pot dealer, or whatever else may be the case. Of course, the regulations that we're talking about here don't change any of these capabilities for those who have self-hosted wallets, because here's the thing. So you need to prove that the address you're withdrawing to is yours and not the address of some undesirable third party. So how much of a burden does that create? Okay, I prove that it's my address. In fact, I use one of my own addresses. I withdraw from the exchange. And then I do another transaction and send it to, let's say, my pot dealer. So instead of withdrawing directly from the exchange to my pot dealer, I first withdraw to my wallet and then I send it. Okay, I don't have a pot dealer, and I certainly wouldn't spend my beautiful Bitcoin on that. But some people do. And so this is terrifying to the financial regulators that want to control the endpoints of every transaction. But you can't actually do that on a decentralized open network such as Bitcoin. And the reason you can't do it is because I can generate as many addresses as I want on my wallet. So can every other recipient who's trying to transact with me. And if I need to do an extra transaction to add another hop, to put one hop distance between me and the exchange withdrawal, I can easily do that. So can everybody else. So this regulation is kind of pointless. It's pointless because you can't enforce it. You ask me to testify that in fact it is my address. So first of all, a lot of people will simply lie, and then they'll withdraw directly from the exchange to an address that belongs to someone else, even after they've testified that it's theirs. Some people have come up with some more elaborate schemes. How about we make users take a screenshot? Seriously, some days I really doubt whether any of these legislators have ever tried floating some of these ideas with their 14-year-old child and seeing how long it takes that 14-year-old to bypass this incredible regulatory edifice that they've come up in their brilliant senile minds. A screenshot? Really? All right, so have you heard of this thing called Photoshop? Okay, not only is a screenshot pointless, but you can't even do that with even more elaborate technical measures. So instead of a screenshot, let's get sophisticated. We've heard of Bitcoin, we know a bit about it. Let's ask the recipient to sign a message that we generate on demand that proves that they control that address. Great, so you put that regulation in place, and now when you send me the challenge message, I have to send it to my pot dealers for them to sign to prove to you that it's actually my address. It's pointless. You see, the problem is no matter where you put that barrier, you only have to go one step beyond in order to bypass that barrier. Here's what the exchange CEOs are really worried about. If you are a user and these regulations come into practice, you will very quickly realize that in order to get the full power of your Bitcoin, you're going to have to do 2 transactions. You're going to have to do 1 transaction from the exchange to a self-hosted wallet that you control, and from there you now have the freedom to send it wherever you want. Which then begs the question, why the hell would you leave it on the exchange in the first place if the self-hosted wallet actually gives you all of the power, but every time you have to move it out of the exchange, you have to pay an extra transaction fee? Why not do 1 transaction, move everything out of the exchange onto your own self-hosted wallet, and then you are actually in control of your own money? Not your keys, not your coins, becomes a reality. You see, the problem is, financial regulators can regulate financial services. They cannot regulate the operation of software on your computing device. If they regulate financial services, those financial services become less useful as compared to the free software that you're running on your own device. And of course, none of the exchange CEOs want you to realize that their system, which is custodial, is the only thing that's actually subject to regulation and can be regulated, and therefore is an inferior product in which you have more fees for less control. And that's why they object to these regulations. What is the impact of these regulations? The impact of these regulations is to drive more people to self-custody and control over their funds, because they realize that exchange wallets are a poison chalice. And so that's my opinion on that. In the same general theme, and the theme of course is not your keys, not your coins, Tobi asks, do you see a danger of Bitcoin becoming fractionalized by, for example, PayPal, in a way that the total available balance from all accounts will inflate the actual supply? No, but I do see a danger of PayPal becoming fractionalized while trying to chase the price of Bitcoin to the point where that renders them bankrupt. You see, the problem here is that for institutions like this that attempt to offer a non-Bitcoin settled proxy to Bitcoin wallet that you can't withdraw from, is that they need to keep going back at market prices and buying Bitcoin to top up their reserves. And they need to do that as quickly as possible in markets that may be less liquid than the demand they have on the front end of PayPal. This means that there is a window of risk between the moment that someone says, I want to buy some Bitcoin on PayPal, and the moment that PayPal then buys Bitcoin to fill up their reserves. So one of 2 things happens. Either they have to have over 100% reserve. To be safe, they have to not sell a Bitcoin that they don't yet own, because otherwise they run the risk of a massive run on the bank if there's panic selling or even profit taking and the market turns upside down on them. This risk of arbitrage between their platform and the open markets is a very, very real risk. Now, either they have to keep greater reserves than 100%, or they have to keep trying to catch up to 100%, but in that period of time when they have less than 100%, their risk to being exposed to wild swings in prices is very, very, very high. So yes, if you buy your Bitcoin on PayPal, you didn't buy Bitcoin. What you bought is exposure to the price of Bitcoin mediated by a custodian who you hope is doing good risk management practices, but who you cannot audit for their actual existence of reserves. This is great for price speculation. It's great for driving up the price as more and more people line up to become second-class citizens of the Bitcoin system. But it's not very good for those second-class citizens. They do not get the full exposure to all of the capabilities of the Bitcoin system. They only get a fraction of the full rights and privileges that accrue to someone who has control over their own keys. I don't think this is a risk to Bitcoin, but I do think it's a risk to these intermediaries who find themselves exposed to wild swings in prices and the possibility of extreme arbitrage. Now, the real risk, however, to Bitcoin, and this is where things get tricky, is that if more and more Bitcoin is owned by intermediaries like this, held in the treasuries of companies like MicroStrategy or Square or PayPal or JP Morgan Chase, these companies now control keys that control Bitcoin on the chain. And that means they are now participants in consensus. Whether we like it or not, consensus emerges from economic activity. People who have keys that control money have power in consensus. And why is that? Let me give you a simple example. Let's say that I come up with a new invention that is broadly popular within the Bitcoin developer community called confidential transactions. That is not an arbitrary example. It's a real technology that was invented by Greg Maxwell and others, and provides very high level of privacy by encrypting the amounts of Bitcoin transactions. Now I want to introduce that to all of Bitcoin, and in order to introduce that, we have to introduce a soft fork, maybe a hard fork. And in order to get that change implemented, we need to get all of the constituencies of consensus aligned. Well, here's the thing. As far as exchanges and MicroStrategy and Square and PayPal are concerned, privacy is not a big priority. Not only is it not a big priority, but it makes it much more difficult for them to continue operating their business in the face of regulatory demands. So they will push back hard, and they may end up pushing back hard enough that that change is not implemented in Bitcoin. So this is the risk. The risk is that by having more and more intermediaries whose interests are the interests of regulated corporations and not aligned with the fundamental principles of open, decentralized financial sovereignty, that creates some very big risks for Bitcoin's future, which is why I'm against financial intermediaries like this. I'm against the introduction of exchange-traded funds. Yes, number go up. Yes, to the moon. Yes, hodl hodl and all of that bullshit. But at the end of the day, what you're doing is sacrificing principles in order to get price appreciation. And that story does not have a good ending. Now, I'm hoping that the risks that these intermediaries face, regulatory risk, arbitrage risk, etc., are greater than the risks that Bitcoin faces from the concentration of power of these intermediaries, gradually making it less palatable for them to operate in our industry, and that we have fewer of these intermediaries really surviving the competition that is imposed by open, decentralized systems. But, you know, that's an optimistic perspective, and sometimes things don't work out so well. All right, so we've talked about whether using an intermediary exchange or using a wallet on an exchange is a good idea. We've talked about not your keys, not your coins. We've talked about custodial versus non-custodial workshops. So now that I've got your attention, and by that I mean there's 350 people watching this live, I'm going to tell you about a new workshop that I launched just a couple of weeks back called Choose Your Cryptocurrency Wallet. A lot of people who enter this space for the first time have a lot of difficulty figuring out how to buy and hold, use, transact, and sell their cryptocurrency, whether that's Bitcoin or whether they've been attracted to the zoo of other cryptocurrencies that exist out there and have gone off into the shitcoin side and bought all kinds of other things. No matter what your attitude towards these things are, the same principles apply. And the core principle, which applies to every part of our cryptocurrency industry, if you want to call it an industry, movement, if you want to call it a movement, is not your keys, not your coins. So that's the fundamental principle. But with that principle comes a lot of complexity. Custodial, non-custodial, hot versus cold, single versus multi-currency wallets, mobile, desktop, web, browser wallets, hardware wallets. How do you know where to start? And I have a good answer to that. And that answer comes in the form of a workshop called Choose Your Cryptocurrency Workshop, which I'm going to plug shamelessly right now. You can actually get access to this on my website, aantonop.com. We currently have an across-the-board 20% discount, which you can use to access that workshop. It's got a lot of videos, supplemental lessons, quizzes, and other information. And at the end, you get a nice certificate of completion to recognize your accomplishment. Here's the information. There's two workshops currently available. The Introduction to Bitcoin and Open Blockchains, which we've had up for more than a month now. That's a free workshop. And the Choose Your Cryptocurrency Wallet, which is everything you need to know to confidently choose a cryptocurrency wallet. So if you're interested, check those out. And thank you for giving me the opportunity to tell you about these workshops. Let's go to another quick question. Is Bitcoin direct from mining pools considered either virgin or white? Is there any reason to value uncirculated coins more than the ones that have circulated? Okay, all kinds of problematic connotations with virgin white. I'm just going to roll with it. Let's think about this in terms of fungibility. Fungibility is a property of money that one unit of currency is indistinguishable and of equal value to another unit of currency. A lot of people talk about fungibility in Bitcoin and describe that as a bit problematic, and in fact it is. Bitcoin keeps a history of the origins of every coin so that you can see which addresses it has been transacted through. And that means that under certain circumstances, a coin can be tainted by its history. Tainted because it has touched an address that has some obscure or negative origins. There are already lists of addresses that are considered suspect, perhaps those involved in exchanges that were hacked, or involved in marketplaces that traded in goods that were illegal in some places and not others, etc., etc. So these types of addresses then taint the coins that are transacted through them. And in some cases, people have found that when they go to deposit their coins onto an exchange in order to sell them, the exchange then turns around and blocks their account, seizing their money because their money came from a suspicious source, or asking for a ton of documentation so that they can prove that they came about this money legitimately, for whatever the meaning of the word legitimate is, depending on your jurisdiction. And of course, that can create all kinds of headaches. Now, theoretically, what this should do is it should create a price discrepancy between coins that have no history such as coins that exist directly mined in a block as the block subsidy or fees in the Coinbase, versus coins that have history, whether that history is good or not. Just simply having history means that it's possible that history is not good. I have not honestly seen this price discrepancy arise. I keep hearing about it. I keep hearing people say that virgin Bitcoin or Bitcoin from the Coinbase is more valuable. It trades at a higher premium, but I haven't actually seen that in practice. Part of the reason, of course, may be an issue of liquidity, which is there aren't that many open markets where you can trade these history-less coins, and those markets by definition have low liquidity because the supply of coins from the Coinbase is limited to the issuance and is a fraction of the liquidity that is available on markets of coins with history. So who knows what the reason is? So far, I have not seen any price discrepancy. Over time, if Bitcoin's fungibility gets worse, I would expect to see that to emerge as a price discrepancy between coins that have and do not have history. And in that case, it might be advantageous to mine as a means of acquiring Bitcoin. I know there's even some of my patrons and some of the people who are on the chat today have told me that they mine Bitcoin not because it's particularly profitable, but because it gives them the opportunity to get coins that are sourced anonymously or with a great degree of privacy and with no history. And I've heard that from a lot of miners. So a lot of miners do so on a very small scale, on a personal scale almost, even at a loss, where it actually costs them more to mine a coin than what they could pay to buy it on Coinbase. And if you like, that's already an indication of a price premium. If you're willing to spend more money on ASICs in order to mine a coin without history, that means you're willing to pay more for that coin without history, and that's already a price discrepancy. All right, so this is a good time for everybody to do an emoji storm while I prepare for the next segment, which we call Down the Rabbit Hole. So give me a brief second, and why don't you do a quick emoji storm while I prepare for that. Wait, what's an emoji storm, I hear you ask? Well, if you are a YouTube member, in the chat you have access to some 12, I think, or 16 custom emojis that are Bitcoin themed and with other cryptocurrency themes and various memes. And they're silly and they're ridiculous and they're completely pointless, but they're lots of fun. So if we have some people in the chat who currently have access to YouTube membership, they will now demonstrate that by showing you many of the custom emojis that are available. All right, it's time for that special segment that we call Down the Rabbit Hole, where I answer a question that you didn't ask me, but which I wish you had asked me, and I ask it of myself and then proceed to answer it. And this is a really selfish section. It's where I get to do whatever the hell I want and enjoy myself by answering questions that I think are fun to answer. Now, last live stream, our Down the Rabbit Hole question, which is a very popular one, was about guessing a private key, and it related it to the number of molecules of silica in a grain of sand, and the grains of sand in all the beaches and all the planet on all of the oceans of our planet, and then all of the planets in our solar system, and then all of the planets in the Milky Way, and then all of the galaxies in the universe, and related that to the number of a private key. Let's expand on that one. In this Down the Rabbit Hole, I'm going to answer a question you asked as a follow-up to a previous rabbit hole where we talked about why it's impossible for someone to guess your private key by relating it to very large numbers of cosmological scale and significance. Now, the follow-up question we got was, okay, so if a Bitcoin private key is such a big number that every atom in the observable universe could have its own Bitcoin private key, and you could never guess it because that's the same as guessing which atom in the entire observable universe is my atom out of all of those out there. How does this relate to mnemonic phrases? Is it more or less difficult to guess a mnemonic phrase? What is the scale of a mnemonic phrase? Is a mnemonic phrase just as difficult to guess? A lot of people have a lot of confusion when it comes to mnemonic phrases or seed phrases. What is a mnemonic phrase? What's up with that? All right, let's explain what a mnemonic phrase is. You've probably heard me say that a private key in Bitcoin, just like a Bitcoin address or a Bitcoin signature, is just a number. Everything we're talking about here is just numbers. There's nothing magical. So a Bitcoin private key is just a number. A Bitcoin address is just a number. We write them in different ways. And you may have heard of this concept of a mnemonic phrase. You've probably used it if you have your own self-custody or non-custodial wallet. A mnemonic phrase is a collection of between 12 and 24 English words, which is used to back up your own wallet. When you first run a wallet, maybe a mobile wallet on your mobile device that is non-custodial, or a hardware wallet that generates keys for you, the first thing it's going to ask you to do is back up this phrase. And it's going to show you 24, let's say 24 English words. Now, this is based on a standard called BIP 39, the Bitcoin Improvement Proposal 39, which sets the standard for mnemonic phrases as they are known. A lot of people call them a seed phrase or simply seed. Not exactly correct terminology, but we'll run with it. So the seed phrase, it's called the seed phrase because if you have those 24 words, you can recover your wallet, all of its transactions, all of its keys across multiple cryptocurrencies. Even if you've been using that wallet for years and you've done thousands of transactions, generated thousands of addresses across hundreds or even thousands of different cryptocurrencies, all of that can be recovered from these 24 words. How is that possible? And how is it different from a private key? And how difficult is it to guess those 24 words? So that mnemonic phrase, those 24 words, which can be expressed in a variety of languages, but let's stick to English for now, come from a dictionary. And this dictionary has 2,048 words in it. It's a fairly small dictionary. It was designed by Satoshi Labs, the company that first proposed this standard. And it was a development of an idea previously created by the authors of the Electrum wallet. But here's the really key idea that you have to understand. A mnemonic phrase made of 24 English words is a number. It's just a number. It's a number that's written in English words, but it's still just a number. So how do you make a number out of words? Well, I mentioned that this dictionary has 2,048 words in them. First word, if I remember correctly, is about. The last word is zebra. And in between, there's 2,046 other words alphabetically: about, above, aardvark, etc. all the way down to zebra. Now, if you think of this dictionary, you could line up all of the words from about through zebra and then put a number next to them. And if you put a number next to them, about would be 1, above would be 2, etc., all the way down, and 2048 would be zebra, or zebra would be 2048. So you can see how if you have a dictionary with 2048 words in it, then you could basically assign a number between 1 and 2048, indexing these words, and therefore you can see how each one of these words can be a number. Now think of the 24 words in a row as a series of 24 numbers, numbers between 1 and 2048, and you begin to see how this is simply a numeric encoding system. So when you write out a number in decimal, you use digits 0 through 9, and the position of the digit is important. And if you put lots of these digits together, you come up with some pretty big numbers. A Bitcoin private key, for example, is a 77-digit long decimal number. And that can be encoded as 10 to the 77. It corresponds to the number 10 to the power of 77 because it's a combination of 0 through 9 repeated 77 times. So you can choose the first digits, 0 through 9. That gives you 10 possible combinations. Then the second digit will be 10 more possible combinations, so 10 times 10. Times 10 times 10 times 10 times 10, and for 77 digits you multiply 10 with itself 77 times and you end up with 10 to the power of 77. Now let's do that with the words of a mnemonic phrase. The first word, which is between about and zebra, is a number between 1 and 2048. So you can choose 2048 possible options for the first word in your 24-word sequence. The second word also gives you another 2048 choices to pick from, again, about through zebra. And so if you took a 2-word mnemonic phrase, how many combinations does that have? Well, it has 2048 combinations for the first word times 2048 possible combinations for the second word. So 2048 times 2048, or 2048 squared. If you had a 3-word mnemonic phrase, then it would be 2048 times 2048 times 2048. You're beginning to see a pattern here. So a 24-word mnemonic phrase is effectively 2048 to the power of 24. That's how many possible arrangements of a 24-word phrase exist. 2048 choices for word 1, 2048 choices for word 2, 2048 choices for word 3, times, 24 times for 24 words, 2048 to the power of 24. Turns out 2048 to the power of 24 is actually 2 to the power of 64 is actually, is 2 to the power of 2. Let me try this again. Backtrack. 2048 to the power of 24, which is your mnemonic phrase, is the same number as 2 to the power of 264, which is slightly bigger than a 256-bit key. And the reason for that is because the mnemonic phrase has a checksum in it to make sure that we don't mess it up when we're transcribing it. So effectively, the 24-word mnemonic phrase is the same size as a private key. And if you take that as your starting position with a special function, a derivation function, you can actually generate a sequence of keys from that first one in such a way that it always generates the same sequence of keys, which allows you to restore an entire wallet with multiple cryptocurrencies and perhaps thousands, tens of thousands of transactions from that single number. A mnemonic phrase is a number, and it's a number as big as a Bitcoin private key, slightly bigger because it has a checksum, and therefore picking or guessing your 24-word English mnemonic phrase is equivalent to guessing a Bitcoin private key, is equivalent to picking one atom out of the observable universe. And that's why mnemonic phrases are not only a secure mechanism and cannot be guessed, but also a convenient mechanism because it's a lot easier to read, write down, and read again 24 English words than it is to try to back up a 77-digit decimal number or a 256-bit digit binary number onto a piece of paper. And that was our rabbit hole for today. All right, there was a quick follow-up question there. Someone said, can words repeat in a mnemonic phrase? Yes, they can. So about 23 times, plus one more word that matches the checksum is a valid mnemonic phrase. In fact, that's one of the test phrases that is used to make sure that your algorithm is correct. I don't remember what the last word is. The last word in a 24-word mnemonic phrase, or part of the last word, contains the checksum. So you could essentially freely pick the first 23, but the phrase would only be valid if you picked the 24th one correctly so that it matched the checksum. And that's to prevent transcription errors. There's another really interesting feature of mnemonic phrases, which is the dictionary of 2048 words has been chosen in such a way that you only need the first 4 letters in the English dictionary of mnemonic phrases. You only need the first 4 letters of the word to uniquely identify it, meaning that if you have the first 4 letters, only one word in the dictionary starts with those 4 letters, and you don't need to, you can't confuse it with another word also in the dictionary. The words are also quite distinct and fairly commonly used words, so that there's no opportunity for confusion about what the word is when you're reading it. So it makes it a lot easier to transcribe. Because you only need the first 4 letters, you can actually record a mnemonic phrase of 24 words with only 96 characters, which is very useful when you're recording it, for example, on a steel backup device. Because by simply recording those 96 characters, you have the full 24-word mnemonic phrase, 4 characters each, etc., etc. All right, so that's all the time we had today. Thank you so much for joining me. We had, I think at peak, more than 375 people joining the live stream. I really appreciate you taking the time on this beautiful Saturday afternoon to join me for this open topic live stream. Now, next week we have a bonus live stream with the topic of passwords and 2-factor authentication, followed by the week after awkward holiday conversations. In fact, we've already reached out to patrons and YouTube members to ask you to share the stories of your recent, or perhaps from past years, awkward holiday conversations. Awkward holiday conversations, of course, in the topic of Bitcoin, open blockchains, cryptocurrency, whatever you want, or even, if you like, the politics of cryptocurrencies. I'm sure there are many awkward conversations. I have been asked if I use cryptocurrency to buy drugs. That was an awkward conversation. It made me feel very uncomfortable that someone would ask me that. But I'm sure that you have even better awkward holiday conversations to top that. So please share them in the comments on Patreon. Share them in the comments of this video. And share them in the YouTube community discussion forum, and I look forward to discussing those in more detail. I'm going to try and give you better answers for those awkward holiday conversations so that you can be best equipped if you end up having them, which may be by Zoom this year. Thank you so much. It's been a pleasure. Have a wonderful weekend and see you next week. Bye-bye, everyone.